Imagine the greatest financial tides of history, boom cycles, pandemics, wars, revolutions. Yet, there are specific assets that stand undeterred. Acquire these five, hold them through turmoil, and they become engines of perpetual wealth. Today, I'll show you why and how. The world runs like a machine. Every part of it is interconnected, operating through cause and defect relationships that repeat over time. To understand wealth, investing, and the sustainability of success, you can't just look at the moment in front of you. You have to study the patterns that have played out for centuries. When you view the economy and markets as a system, you begin to see that nothing is random. Every rise, every fall, every period of prosperity or pain comes from forces that have always existed and will continue to exist. What drives this machine are cycles. There are short-term cycles, usually lasting about 5 to 10 years, driven primarily by credit expansion and contraction. Then there are long-term cycles, spanning decades, driven by the accumulation of debt, productivity growth, and shifts in reserve currencies and empires. Most people get caught up in the day-to-day noise, but the ones who build lasting wealth learn to look past it, to focus on where in the cycle we are, and to prepare accordingly. Think about it this way: in a credit-driven economy, when money is cheap and plentiful, borrowing expands, spending rises, asset prices go up, and people feel wealthier. That's the upswing. But because debt grows faster than income during those periods, eventually obligations exceed what can be sustained. At that point, the cycle shifts. Borrowing slows, spending contracts, assets fall, and the downturn begins. If you understand this process, you're not surprised when markets fall. You expect it. You know the boom was laying the seeds of the bust, just as the bust will eventually lay the seeds of the next recovery. The long-term cycle is even more important to grasp. Over many decades, societies accumulate larger and larger amounts of debt until the burden becomes overwhelming. At the same time, productivity and innovation can offset this for a while, creating growth. But history shows that debt cannot compound forever faster than income. When that gap gets too wide, monetary systems are forced to change. Sometimes it's through devaluations, sometimes inflation, sometimes a restructuring of debt, and sometimes the rise of new powers that replace old ones. If you study history, you'll see this pattern clearly. From the Dutch Empire and guilder, to the British Empire and pound, to the American Empire and dollar, every reserve currency, every leading power, has followed the same arc. For investors and builders of wealth, the lesson is simple but profound. You cannot anchor yourself only in the present. What feels permanent in the moment is just a stage in a repeating cycle. To navigate effectively, you have to zoom out, study history, and recognize the timeless patterns. Most people only live through 1 or 2 long cycles, which makes it hard for them to see clearly. But the patterns are always there if you step back far enough. This way of thinking also helps temper emotion. When markets are soaring, people tend to believe they'll never stop climbing. They overextend themselves, borrow too much, and chase the top. When markets collapse, people panic, sell at the bottom, and convince themselves the pain will never end. Both reactions come from ignoring the reality of cycles. If you understand that downturns are as natural as upturns, and that both are part of the same larger machine, you stop reacting emotionally and start preparing rationally. You don't try to predict the exact timing of every move. You build a strategy that can withstand all parts of the cycle. Wealth that lasts across generations is never built on guessing the next headline. It's built on positioning yourself so that you are not destroyed in the bust, and so you can take advantage of the opportunities it creates. The best opportunities always come when others are forced to sell, when panic is at its peak, and when those who overextended themselves cannot hold on. If you understand cycles, you know that these moments will come, and you prepare your portfolio, your cash, and your mindset to act when they do. The system will keep running as it always has. Debt will rise and fall, productivity will expand and contract, and currencies will gain and lose strength. Nothing about this is new. The only question is whether you'll see it for what it is, a repeating set of patterns, or whether you'll be like most, trapped in the illusion that the present moment is unique. Those who learn to think in systems and cycles put themselves in harmony with reality. And when you're aligned with reality, you gain the rare ability to build wealth that endures across time. Would you like me to now do the same 700-word expansions for the other 4 keynotes? Diversify across uncorrelated assets, seek friendly risk-adjusted returns, use assets that are built to endure, and define principles and stick to them, all in the same style, so you'll have a full series ready for your channel. Most people think diversification means holding a handful of different things. They own a few stocks, maybe some bonds, and they believe they're protected. The reality is that if those assets are highly correlated, if they rise and fall together, then you don't have diversification at all. Real diversification comes from combining assets that behave differently under different conditions. It's about blending exposures in a way where weakness in one is offset by strength in another. That principle is the key to reducing risk without sacrificing return. The truth is that no one can consistently predict what environment we'll be in next. Will growth accelerate or slow? Will inflation rise or fall? Will interest rates go up or down? Each of those shifts creates winners and losers across asset classes. Stocks do well when growth is strong and inflation is low. Bonds do well when growth is weak and inflation is falling. Commodities and inflation-linked assets thrive when inflation picks up. Currencies, real estate, and alternative investments all have their own environments where they shine. If you concentrate on just one of them, you're betting your future on being right about the next environment. And history shows us that no one is always right. What makes diversification so powerful is that you don't need to be right. You don't have to know what will happen next if you have a portfolio balanced across assets that respond differently to the same conditions. When one part is hurt by rising inflation, another is helped. When growth stalls, something else picks up the slack. The result is that your portfolio's volatility, the ups and downs, falls dramatically, while your expected return can stay the same or even improve. There's a simple mathematical reality here. If you can combine enough uncorrelated return streams, say 15 or more, the overall risk of your portfolio can fall by around 80% without giving up return. That is the essence of the holy grail of investing. It's not about finding the single best asset or chasing the highest performer. It's about engineering a mix of exposures that work together across environments. The compounding of steady returns, with fewer big drawdowns, produces far more wealth over time than chasing whatever looks hot in the moment. The mistake most people make is chasing performance. They see what worked yesterday and assume it will keep working tomorrow. They load up on tech stocks after they've already soared, or they pile into real estate when prices have been climbing for years. Then, when the cycle turns, as it always does, they are overexposed and their wealth evaporates. If instead they had built a portfolio with uncorrelated pieces, they would have been cushioned. The decline in one part would have been offset by another that was gaining. That balance is what protects you and keeps you compounding. Another mistake is believing cash is diversification. Holding cash might feel safe, but over long periods, inflation erodes its value. It's not enough to simply hold less of what scares you. True diversification means holding the right mix of assets that perform in different conditions. Cash can play a role as dry powder for opportunities, but it cannot be the foundation of wealth. The key is to think in terms of economic drivers. Ask yourself, what makes this asset rise or fall? If you understand that, you can pair it with another asset driven by different forces. For example, equities and bonds often balance each other because they respond differently to growth shocks. Gold and inflation linked securities balance out the risk of rising prices. International exposure balances out domestic concentration. Even within equities, having different regions and sectors adds resilience. The goal isn't complexity for its own sake, it's resilience. Over the long run, diversification across uncorrelated assets is the only free lunch in finance. It's the closest thing to a principle you can rely on with certainty. You don't know which cycle you'll live through next. You don't know how governments, central banks, or global events will shift the environment. But you do know that some assets will do better than others in any given condition. By holding them all in balance, you position yourself to survive and thrive regardless of what the world throws at you. Wealth built on concentration is fragile. Wealth built on diversification is enduring. The difference is that one assumes knowledge of the future, while the other accepts uncertainty and prepares for it. The world will always surprise us. Crises will come, bubbles will burst, and cycles will turn. The people who last are not the ones who predicted perfectly. They're the ones who constructed their portfolios intelligently, with enough uncorrelated pieces to weather any storm. That's how you build wealth that not only survives but compounds steadily over a lifetime. When most people think about investing, they focus almost entirely on returns. They ask, how much can I make? But that's the wrong question. The right question is, how much risk am I taking to get that return? Wealth is not built by chasing the highest possible number. It's built by consistently earning the best return relative to the risks you face. That's what truly compounds over time. If you understand that every investment has both a potential reward and a potential risk, then you realize that returns cannot be considered in isolation. Two investments might both offer the chance at 8% annual returns, but one could expose you to twice the volatility, twice the chance of losing everything compared to the other. In that case, the first is not equal to the second. What matters is the ratio. How much return per unit of risk you're taking on. The higher that ratio, the better the investment. This way of thinking changes everything. It shifts you away from the gambler's mindset of trying to hit the jackpot and toward the disciplined mindset of constructing a portfolio that's resilient. It also protects you from the classic mistake of confusing luck with skill. In good times, people assume they're geniuses because everything they touch goes up. Then, when the cycle turns, they lose it all. They weren't geniuses. They were simply taking more risk than they realized. Consider what happens when you prioritize risk-adjusted returns. You may give up a little on the upside, but you dramatically reduce the downside. That matters more than people think. Losses hurt more than gains help. If you lose 50% of your wealth, you need to double it just to get back to where you started. That's why minimizing big drawdowns is critical. Protect the downside, and the upside will take care of itself. This is also where diversification becomes even more powerful. By blending uncorrelated assets, you not only reduce volatility but also improve your return to risk ratio. Think of it as smoothing out the bumps in the road. Each asset has its own risk and return profile, but when combined intelligently, the whole becomes stronger than the parts. Over time, that leads to compounding that is steadier, faster, and less vulnerable to shocks. Another important piece is not confusing certainty with safety. Some people believe government, bonds, or cash are always safe, but in environments of high inflation, holding only bonds or cash is one of the riskiest things you can do, because the real return is deeply negative. What seems safe in nominal terms can be devastating in real terms. That's why you must measure risk not only by volatility, but by your ability to preserve and grow purchasing power. True safety comes from balancing exposures so that you're not overly reliant on any one condition continuing forever. Think about the greatest investors in history. None of them became wealthy by taking blind risks. They became wealthy by carefully analyzing where the risks were, minimizing them, and constructing systems that produced strong returns relative to those risks. It's about discipline and patience, not excitement and speculation. This perspective also applies to personal behavior. Many people swing emotionally with markets, optimistic in the boom, fearful in the bust. That emotional cycle leads them to buy high and sell low, compounding their risks while reducing returns. The way to break that cycle is to build a portfolio that you trust because you know it's structured for risk-adjusted strength. That gives you the confidence to hold through downturns, knowing you're not overexposed. Risk-adjusted returns also highlight why leverage must be used with extreme caution. Borrowing can magnify returns, but it magnifies risks even more. Many investors fall into the trap of thinking leverage makes them smarter, when in reality it makes them more fragile. The most devastating collapses in history came not from bad investments, but from excessive leverage applied to good investments. If you truly understand risk-adjusted returns, you respect the destructive power of leverage and use it sparingly, if at all. Ultimately, the goal is not to win big in any single year. The goal is to stay in the game, to compound steadily for decades. When you think in terms of risk-adjusted returns, you build systems and portfolios that are sustainable. You focus less on hitting the maximum and more on never falling too far behind. Over time, that makes you far wealthier than the person swinging for the fences. The path to lasting wealth is about balance, balancing reward against risk, balancing ambition against prudence, balancing exposure against protection. Those who achieve that balance rarely experience the euphoria of wild gains, but they also rarely experience the despair of catastrophic losses. Instead, they experience the quiet, powerful satisfaction of compounding wealth year after year. That, in the end, is the true secret. Maximize return relative to risk, and let time do the rest. The test of a great asset isn't how it performs when conditions are perfect. The real test is whether it can endure when the world changes, when currencies lose value, when governments shift policies, when economies move from one extreme to another. Too many people build their wealth on assets that only thrive in a narrow environment. When that environment disappears, so does their wealth. The key is to identify and hold assets that can withstand different circumstances, assets that protect purchasing power and preserve value across generations. If you study history, you'll see that every paper currency ever created eventually lost its value. Some collapsed suddenly through hyperinflation. Others eroded slowly as governments printed more and more to cover debts. In each case, those who held their savings purely in the form of money lost purchasing power. What preserved wealth wasn't currency. It was assets that couldn't be devalued at the stroke of a pen. That's why owning things like gold, inflation, linked bonds, or productive real assets has been a timeless principle. They provide insurance against the erosion of money itself. Another enduring asset is human productivity expressed through ownership of businesses. Companies that adapt and innovate are tied to the real economy's growth. Equities, when diversified and held over long periods, reflect the upward trajectory of human ingenuity. They have endured depressions, wars, political upheavals, and still created enormous wealth for those who held through the cycles. The challenge isn't whether equities will be volatile, they always are, but whether they continue to mirror the fundamental reality that people strive to improve, to create, to build. That tendency has lasted through centuries. Land and real estate are also enduring in their own way. Across history, land has remained a source of value. It produces food, provides shelter, and offers space for development. While markets can overvalue or undervalue it in the short run, its fundamental utility makes it a long-term store of wealth. Unlike a currency that can vanish overnight, land doesn't go away. It can change hands, it can be taxed, but its essence as a productive, tangible resource endures. Of course, endurance doesn't mean immunity. Every asset will go through periods of underperformance. Gold can languish for decades, stocks can crash, real estate can collapse in price, but the point is not perfection, it's resilience. Enduring assets recover because they're tied to fundamental, lasting forces, scarcity, productivity, and the necessity of real economic functions. That's very different from speculative fads or assets built purely on sentiment, which disappear once the enthusiasm fades. You also have to think about endurance across borders. No single country, no single currency, no single empire has maintained dominance forever. The Spanish crown once controlled the richest empire on earth, then it faded. The Dutch guilder gave way to the British pound, which gave way to the American dollar. Each cycle left behind investors who believed their system would last forever. Those who endured were the ones who diversified into assets that transcended borders, gold, commodities, and global holdings that didn't depend on one empire's survival. It's also important to distinguish between assets that endure in name and those that endure in function. A currency might endure as a piece of paper, but its purchasing power erodes. A business might endure as an institution, but if it stops innovating, it loses its value. What you want are assets that preserve their function, maintaining purchasing power, generating income, or providing utility, no matter what happens around them. That functional endurance is what protects wealth. This way of thinking is uncomfortable for many people because it forces them to accept impermanence. Most want to believe that the system they live in now will last forever, that the rules won't change, that what has worked recently will keep working indefinitely. But history shows that systems change, often in dramatic ways. By holding assets built to endure, you free yourself from being dependent on the permanence of any single system. You give yourself a foundation that lasts even as the environment evolves. The goal isn't to predict which asset will shine this year or next. The goal is to own pieces of reality that endure across decades. The precious metals that central banks themselves still hold as reserves, the equities tied to human innovation, the land and resources that underpin every society, the bonds designed to offset inflation. Each of these assets serves a role in preserving wealth when others falter. Together, they create a foundation that is not easily broken. Over time, fortunes rise and fall with cycles, currencies come and go, but those who anchor their wealth in enduring assets survive. They protect their purchasing power, they remain liquid when others are forced to sell, and they're positioned to seize opportunities created by upheaval. That is the essence of resilience. Wealth isn't about winning the current game, it's about having assets that allow you to keep playing no matter how the rules change. And in the long run, it's those who endure who build the greatest wealth of all. The most important thing you can do for lasting success is not to find the perfect investment or the perfect moment. It is to define clear principles and live by them with discipline. Principles are timeless rules that guide your decisions through both good times and bad. Without them, you are at the mercy of your emotions, the headlines, and the noise of the moment. With them, you have a compass that keeps you grounded no matter how chaotic the environment becomes. When markets rise, fear of missing out tempts people to throw away discipline. When markets fall, fear tempts them to abandon their strategies. In both cases, emotion overrides logic, and costly mistakes follow. Principles are the antidote. They stop you from making decisions based on impulse and force you to act based on reason. They don't change just because circumstances feel different. In fact, the more unusual the environment becomes, the more important it is to return to your principles. Defining principles starts with studying history and understanding the mechanics of how things work. You need to know the repeating patterns of economies, markets, and human behavior. From that knowledge, you can establish a set of rules: how you will allocate your wealth, how you will manage risk, how you will respond to downturns, and how you will avoid overconfidence in upturns. These rules become your operating system. They remove guesswork and reduce the power of emotion over your choices. The beauty of principles is that they are transferable across time. What protected wealth 100 years ago can still protect wealth today, because the underlying forces of debt, productivity, inflation, and human nature haven't changed. The tools might look different, but the dynamics are the same. Once you've codified your principles, you can rely on them across cycles. They give you consistency in a world that is always changing. It's not enough, though, to have principles written down. You must commit to them. That means holding yourself accountable when you're tempted to deviate. It means testing them against reality, refining them when you see they need adjustment, and sticking with them when everyone else is chasing the latest fad. Many people know what they should do, but they don't follow through. They allow exceptions, they rationalize impulsive decisions, and they convince themselves that this time is different. Principles lose their power the moment you compromise them. One of the most powerful benefits of living by principles is that it gives you clarity during crises. When uncertainty is at its highest, most people freeze or panic. But if you have a predefined framework, you already know what to do. You know how to rebalance, when to hold, when to add, and when to protect. You don't have to figure it out on the spot. That ability to act rationally while others are emotional is what creates opportunity. Another benefit is that principles can be shared. When you build a family, an organization, or a partnership, principles create alignment. They ensure that everyone is operating with the same rules and expectations. This makes decision-making faster and more consistent. Over generations, having clear principles allows wealth to endure because it prevents each new custodian from making the same mistakes of the past. It builds a culture of discipline rather than luck. Of course, principles are not rigid dogma. They must be tested against reality. If you find that one of your rules consistently fails in practice, you refine it. That is how principles evolve into something stronger over time. The goal is not stubbornness. It is consistency guided by learning. The balance is to remain open, minded enough to improve your principles, but disciplined enough not to abandon them in moments of stress. Think about what happens when you live without principles. Every decision becomes situational. You're swayed by the latest news story, the loudest voice in the room, or the strongest emotion you feel that day. That is no way to build lasting wealth. It leads to overconfidence in good times, despair in bad times, and a cycle of repeated mistakes. Contrast that with someone who operates by clear rules. They may not always be perfect, but they are steady. Over time, that steadiness compounds into results far greater than those who chase every twist and turn. In the end, principles are what separate enduring wealth from fleeting fortune. They allow you to step back from the noise, see the bigger picture, and act in harmony with the underlying mechanics of the world. They keep you aligned with reality, which is the ultimate advantage. Without them, you are reactive and fragile. With them, you are resilient and steady. Define your principles, test them, refine them, and above all, stick to them. That discipline is what ensures not just wealth, but wealth that lasts. Life's currents are unpredictable, but wealth, real, lifelong wealth, is not about predicting the next crash, but anchoring in the right assets, held steadfastly. Build your foundation on unshakable principles. Own these 5 pillars, never sell, and let compounding, discipline, and systemic strength do the rest. That is the secret to lifelong wealth.